Right. Morning, everybody. Welcome to another one of our webinars. I'm Nick Brummer, Director at Investonline, and joining me today is Stuart, Dyer, my fellow director. We're coming from Cape Town, Newlands, a little bit miz and wet today, cold, wintry. Today we're talking about estate planning, really important, how it fits in with your financial plan, and it goes hand in hand. We really go through a lot about it. We really try and break it down as easy as possible. Investonline, as you know, we're a team of 15. We do financial planning and investment advice. And Stuart, I'm going to hand over to you. And I'm going to chip in. And then also we got quite a few good questions that were asked up front. Thank you.
Hi, good morning, everyone. Thanks, Nick, as always. Thanks to everyone who's joining today. So what we're going to be going through is estate planning today. We're going to keep it quite simple in this presentation. You'll notice I've removed more legal jargon, going through the concepts, how I would like to think of them, what are the key areas one needs to be aware of, what does one really need to pay attention to, and we have got some really good questions. I think we had around 50 questions or so, or potentially even more, that were submitted on registration. We selected 8 of them that we'll cover after I go through some of the content. So just what we're going to go through today, I'm going to give a brief definition of estate planning, talk about practical questions first. So what that means is your estate plan needs to be practical first and tax efficient second. You can't always do everything to be tax efficient if it's not practical. What it costs to die, so essentially what are your estate costs? Liquidity, having enough cash ready. We'll talk about what that means. How an estate is shared out or distributed. Your home and fixed property. Naming beneficiaries. Where trusts and companies fit into your estate planning. A practical example, and then Nick will ask me those questions and we'll tackle those questions together at the end. So with estate planning is really making sure the right people receive the correct assets with the least delay and cost, exactly as you intended. So all it is really you taking the time to lay out your wishes for your assets or your investments and putting together an actionable plan to make sure that those who you intend to get the capital and X amounts of assets does get that, while paying the least estate duties, taxes, and costs that one can plan for. So it starts with your wishes. As I mentioned, tax efficiency comes second. I see it a lot, particularly with those maybe more accounting minded, where they can do a lot of things from year to year, especially around tax returns, always focusing on what's tax efficient in life, not always thinking about what's most practical when it comes to passing. So I always think you have to make sure that your estate plan is actionable and practical, and tax efficiency is a nice to have after that. Has to protect your family, so or whomever your beneficiaries may be, needs to fit in with your life. So as I said, I think estate planning, as well as those who work with us would know, an investment strategy is very personal. Estate plan really needs to be customized for what investment accounts you have. Do you have a trust? Do you have a company? What assets do you have outside of your investments? I think an off-the-shelf template for a will is not necessarily the right way to go. It may work for you, but it's definitely worth having a conversation to see what potentially you're missing in your estate plan. So the practical questions is, one big requirement is to have a valid current will. When last did you go through your will? Does it still reflect your wishes? I know with wills, there's been a lot of language changed in the last 10 years, and often updating or amending one's will just to match the latest language is important, to make sure that there's absolutely no doubt around the legality of your will and your wishes being as clear as possible. The right executor. I know some people like to nominate a family member as the executor, potentially even a spouse. I think you need to give a fair amount of thought to who you nominate as your executor. One needs to bear in mind that potentially if you are still um, younger in life, that if you had to have a family member or spouse be your executor, may be quite hard for them to deal with the administration around winding up your estate, as well as dealing with your loss. So I think to pay quite a lot of attention to that or give it some thought. Often what can work is to nominate a professional as well as a family member. If you've got anyone who's a more qualified family member, sibling, or a child, potentially financially qualified, to then be nominated as a co-executor is an arrangement we see quite often. This is one I'm going to touch on more closely, is to make sure your beneficiaries are up to date. We'll go through how the winding up of an estate actually works, but in terms of where a beneficiary nomination fits in, it's very, very important. So on your investment policies and your life policies, if you have anything where you're able to nominate a beneficiary, that actually supersedes the importance of a will. So that gets dealt with on a product level. And it doesn't make sense to keep updating your will, but not revisit your beneficiaries regularly, because your investment values may grow over time and change, and you need to review those percentages to see how much those beneficiaries are actually going to get, and make sure that that's still in line with your wishes. And then if you are married, generally married persons is the big estate issue comes once both are passed, especially if the plan is to pass on a meaningful amount of assets from one spouse to another. When you pass on assets from one spouse to another, that's exempt from things like estate duty, and capital gains tax also get rolled over from the passing spouse to the surviving spouse. So if you are someone whose plan is, let's call it a joint estate plan with a spouse, the big tax bill comes when both pass away, and you need to consider that. How are those estate costs going to be paid, and how is that plan going to look when your assets then go to other individuals, which may be children or other family members or a trust. So when it comes to winding up your will, always remember that the costs that your estate have to pay come before your heirs get their money. So this doesn't include the beneficiary nominations I mentioned in the previous slide, but when it comes to whatever is going to be wound up by your estate, is the passing of money to your heirs is the very last step. And if anyone's been involved in the winding up of an estate, you would know how long things take and how complex the steps are before you actually get to that step of handing out the assets to the various heirs of the will. So big thing is that how it works is your estate late. If someone had to pass away, it's almost seen as you stopped owning all of your assets the day before you passed. Your final tax return goes up to the day before you passed away. And then your estate late of your name becomes its own almost financial entity, if you will. And that has its own tax return and its own investment accounts that run, where the estate late and the executor as the manager of that basically owns all of your assets while the administration process is taking place. At the end of that process, everything gets paid out of the estate late's bank account. While the calculations are all taking place, the estate is pretty much frozen. The spouse may have a maintenance claim on the estate, but any other heirs, you pretty much can't access those assets or those investment assets financially while the estate winding up process is taking place. And the costs that you have to pay, which we'll cover shortly, good planning can, this term used here, is shrink them or reduce them. So it's important to plan where possible. So these are the four main costs that an estate has to pay. I know the first one is the big one. If you have to calculate what your estate's going to owe, is estate duty. This is one that is really, really difficult to avoid or reduce. We can talk through some strategies to do so, and we do cover an example later. So estate duty is the death tax that we pay, similar to inheritance tax, or what they call situs in America, is our death taxes that's paid on your assets that's wound up or on your assets on death. So what's excluded from estate duty are things like your retirement funds. If you have any pension funds, retirement annuities, living annuities, that's excluded from the calculation for estate duty. But most other assets, there are some exemptions, but most assets, financial or fixed assets, are included in the calculation for estate duty, including your foreign assets. So the tax rate is 20% on the first 30 million rand and then 25% above 30 million rand. You are allowed 3.5 million rands worth of assets before estate duty applies. So if your total estate is under 3.5 million rand, then you shouldn't have to pay any estate duty. Executor's fees. This is the one that the executor who winds up your estate will charge you. It's charged directly on your estate as an expense. And they normally, if you don't negotiate, will charge you 3.5% plus VAT. So it's around 4% is what's charged on the value of your estate. So if you just calculate if your estate that they handle is 10 million rand, that's 400,000 rand that they charge you. So it's very important to try and negotiate an executor's fee and to make sure that when doing your estate planning, that as little as possible is actually handled by an executor. By using beneficiary nominations in certain investment vehicles, you can reduce the amount of capital that's handled by the executor when you pass. Capital gains tax. This is something that's triggered when you pass away. The one exemption of this is if your asset goes to your spouse, then the capital gains rolls over. Or if your investments are not owned by you, but rather owned by a company or a trust, then obviously the asset doesn't get sold when you pass. So there are some ways to defer capital gains tax, but normally if you pass away and you own an asset, that asset is seen to have been sold. It's called a deemed disposal the day before you pass. And there are other costs such as master's fees, conveyancing, if depending who your primary home goes to, potentially transfer duties will all apply and all also be paid by the estate. So where does the cash come from to pay these various costs? And this is what you would hear in estate duty terms. It's called liquidity. And liquidity doesn't mean your spouse having access to enough money while your estate gets wound up. Liquidity is actually your estate having access to enough liquid assets to pay the costs. If you think of the estate having its own balance sheet, if you will, it's got its liabilities that it's going to owe, capital gains tax, estate duty, executive fees, or your bequests you may have, your gifts you're going to give various people as per your will, and the executor is going to be sitting there thinking, well, how do I fund this? So some types of cash flow are more logical and how it may be funded. The obvious one is life cover. If you have life cover that pays to your estate, that will normally be the first place the executor will go to then use that to pay out for costs. But most people, as they near retirement or enter retirement, would no longer have life cover. Logic is that you've retired, you've built up your investment wealth, your house is probably paid off, you probably don't have other liabilities. So you then go and cancel your life cover because it becomes unaffordable. And in that case, you need to be more specific on what's going to fund your costs and fund that liquidity. And often that would be different liquid investments. So ensuring that not all your investments are locked up in a trust or locked up in a pension fund, because the executor is going to have to go and basically, if there aren't liquid investments, it's going to have to go and sell less liquid investments, which may include property or may include other assets such as foreign investments that you didn't intend to sell, that you would rather have had the family members or the beneficiaries keep. So this is something that we do with clients. It's very important, is to do what we call a last expenses report. estimate exactly how much your estate would need to pay in terms of liquidity across these various categories, and then go over your assets and say, okay, well, where's that going to be funded from? And what often could happen if you do have investment assets, let's say you've got an endowment or an offshore wrapper, you could actually include your estate as a partial beneficiary to the amount that would then cover the estate costs. As I've mentioned, if you don't actually have a plan, or you haven't specified, or this is something you haven't thought about, then you're really leaving it up to the executor to use their discretion. They call it a fire sale, and that's when the executor is going to look at your estate and just have to use his or her own logic of what gets sold to fund the costs. So it's something that you would rather plan for than have someone who potentially is a third-party professional have to decide. So when you pass, how does that estate winding up process go? So first thing that happens is the executor is finalized. If anyone's been part of a estate winding up, they would know that's a bit of a process. Basically, that needs to be formalized, and the executor gets approved by the Master of the High Court. And once that's done, they've got the document to show that they're the nominated executor and that they ultimately control your affairs. Then all the liabilities are calculated, the final tax return needs to be filed, all of those sorts of things, and those costs are paid. Then as we get closer to what's called the liquidation and distribution part of the estate, which normally comes between a year and 2 years after the passing of the individual, then the bequests are on it. So bequests are basically particular line items you will have in your will. Outside of your general assets, the bequest is a specific gift or thing that you're passing on to someone. It could be a cash bequest or a particular item or whatever it may be, property that you are bequeathing to particular individuals. So that happens before what's called the residue of your estate, which is the leftover, is paid out and split as per the percentages. So first step is to honor bequests. And then the final step is that the rest goes to your heirs. And that rest is called the residue. And that's divided as your will directs. And just a reminder that this only really applies to what your will affect. So what your will won't affect is any retirement funds, anything that's held within a policy with a beneficiary nomination won't be included in this. Anything held within a trust or a company won't be included in this. So your estate plan actually becomes a lot more complex than just your will. Your will is only going to really handle the assets that are governed by the executor, which is normally your house, your liquid investments, anything without a beneficiary nomination. And if you don't have a will, then what's called the Interstate Succession Act comes in. And that's really where the government legislation tells the executor how the assets will be passed on. And that's really ends up being down to your blood relatives. So you lose all discretion if you pass away with a will. The Interstate Succession Act would kick in and your assets would be passed on using that logic. Okay, so how does it work for fixed property? I think fixed property can be quite straightforward, or it can be a little bit more complicated. Generally, it's straightforward. If one surviving spouse passes and or one spouse passes and the surviving spouse stays in the home, then that's quite clean. No transfer duties, CGT, or anything has to be paid. But where fixed property or a portfolio of fixed properties has to pass to various other beneficiaries, which may be children, can be quite complicated. You can't divide a house up like you can with cash or shares. So it can't be split between heirs the way money can. Transfer takes time and costs money. As you may know, you need conveyances fees, you need transfer duties if you're transferring the ownership of a property. And the surviving spouse and the family home need a deliberate plan. And particularly, I've also seen this for holiday homes. So often it can be logical to then look at your estate as a whole and try and cut it up as evenly as one can. Potentially one child will get this house and one child would get this investment to the value of that house, so that things can be fair depending on your wishes. Where you've got properties or a holiday home and you really want to ensure that all your beneficiaries, if you've got numerous beneficiaries, can benefit, then it can be useful to place those properties either into a company which would have a shareholding, or into a trust or a combination. And that can often make sure that things just move more smoothly when you pass. So just to spend some time on the beneficiaries, I can't emphasize how important the beneficiaries are. Is that the beneficiary, any investment assets or policies with beneficiaries on, sits outside your estate. Just to make sure everyone's aware, it doesn't mean it sits out of your estate duty calculation, which is a separate issue, but it sits out of the estate that the executor handles. So if I've got a 10 million rand investment, I'm going to put it into an endowment or a wrapper, and I nominate my spouse as the beneficiary of that wrapper. My spouse can take ownership immediately when I pass, and no executor needs to handle that. I'll still have to pay estate duty on that asset, but there's no hold up or delay in the winding up of the estate. So beneficiary nominations are important, especially if you are wanting to, and revisiting your beneficiary nominations is important, especially when you're wanting to split your money across maybe multiple people. You don't just have a straightforward, everything I have goes to one person, but you've got different children, grandchildren, entities, whomever it may be. Revisiting your beneficiary nominations and how much each person is getting is very important. And if you've got too much of your assets without beneficiary nominations, if you go look at your overall wealth, and we do see this quite regularly, and you realize, okay, I've got X amount of wealth and Y amount is going to be handled by an executor, which is going to create additional delays to my estate, as well as that executor is going to charge me a fee. Even if you're able to negotiate a good fee of 2% or under 2%, it's still an extra fee. Then you should definitely consider, and we would like to provide advice around if there are ways to improve that situation and get more money into different investment vehicles with a beneficiary nomination. So where do trusts and companies fit into this whole picture? So as I stated right up front, trying to keep this a little bit more simple for this presentation. Estate planning can get really complex if you start including trusts, if you start including companies, if you start including strategically putting money into living annuities to benefit from Section 10C. There's a lot that one can do to be smart around estate planning. And ordinarily, where trusts and companies come in is that first and foremost, they both are good practical instruments, particularly in the right situations. So if you're someone who's got material assets, they're going to keep growing and growing and growing beyond your lifetime. And those assets really need to serve your children or multiple generations within the family. Then a trust/company structure, or what often happens is you could have both. You could have a trust that owns a company. Does make sense. If you're someone with beneficiaries who can't manage their own affairs, then there's different trusts you can set up. You can set up special trusts for minor children or individuals with potentially aren't able to manage their own financial affairs. If they're mentally incapacitated or issues like that, you can set up special trusts that allow them to enjoy their normal tax rates, but at least someone else can manage their wealth for them. And when it comes to companies and trusts, there are different benefits, and we've got some good example, or a good example we're going to show. So a big one with trusts is if you've got assets that sit within a trust and not within in your own hands and held in your own name, that the part that grows within the trust and isn't what's called attributed back to you is actually left out of your estate duty calculation. And I will illustrate that in the example coming up, and that's called pegging your estate. which basically is another word for capping your estate. So I'll talk through that more. Trusts in companies, another good practical benefit they bring is that they're very good in terms of asset protection and obviously useful for succession, especially when it comes to businesses. You would see large farming operations would normally be held within large family trusts because it doesn't rely on one person being alive for it to function. Even if the key family member passes away, everything can just continue as per normal. But these days, if you're someone who doesn't have a trust or company already, and you're considering, should you make use of a trust or a company or a combination, SARS definitely is clamping down on these areas. There is still a use case for trusts, but it's not as easy just to go and put all of your wealth into a trust like it was 10 or 15 years ago. So there are costs to it. There are tax implications to be aware of. And it really, in my view, there are some cases where I recommend trusts, and there are some cases where I don't recommend trusts. It really comes down to the personal situation. And the key thing is you have to go and model and calculate what makes sense for you. So let's just zoom in on this example. So here we've got one client, two different outcomes. It's essentially the only thing we're going to show as a difference is the structure. So this individual has a 10 million rand asset. I've assumed that he's around 60 years old and that he's trying to plan now for his retirement. He's still got meaningful time that his assets will grow for. As a calculation, I've just assumed 20 years as a calculation term. And what we're trying to do is we're trying to see what makes sense in terms of structuring. Should he keep owning his assets in his own name, or should he consider something more formal like a trust? This asset that he has, its original cost that he had of the asset was 6 million rand, and 4 million rand is capital gains that is unrealized. So remember, every asset you own, especially growth assets, has the purchase price or the base cost of the asset. And then as it grows, you have this unrealized liability that's your capital gains tax that has to be paid at some point, normally when the asset is sold or when there's a deemed disposal of the asset. And his wishes are to be practical and tax efficient. The most to his family, the least to tax and delay. So we go and model the scenario for him. This is option one. If he had to keep the asset and the ownership of the asset in his own hands, basically he's got his current value of 10 million rand. He keeps growing that asset for 20 years. I always feel that these compounding growth numbers can always look so large, but it's, that's the effect of compounding over time. So you can see the value of that investment when he had to pass, if he had to pass at age 80, would be 67 million rand. Then there would be capital gains tax he would need to pay, a full amount of estate duty, which there is 12 million rand, and then his executor's fees, because this asset is just held in his own name in a discretionary manner. So the total taxes and costs on death would be about 25.6 million rand. So how much would his family actually get? You've got the gross asset of 67 million rand less the 25 million rand. So it's just under 42 million rand. That is actually what the family would get after costs. So it's about a third of the value that was lost to estate duty and capital gains tax over this period. Obviously, a capital gain of that size is taxed at the 18%, which is the highest marginal rate you could have for capital gains tax. Now, if we had to restructure this now at his age 60, and tell him, okay, you're not going to use this asset. This is what we call a legacy asset for your family. And this asset's just going to keep growing meaningfully during your lifetime. We think it's right that you put this in a trust and you peg your estate, which is to cap the estate duty you will owe on the asset. So in this case, he's going to pay a small amount of capital gains tax to move the asset into the trust. And what happens is when you move an asset into the trust, you're basically selling the asset to the trust. And instead of getting capital back for that, you are doing it on what's called a loan account. So you have an asset in your hands, which is now the loan that the trust owes you. but there's no intention for the trust to pay you that loan back. That loan basically sits with you for the rest of your life. Now that asset continues to grow in the trust. And you can see in this case, that asset grows to 54 million Rand in the trust, plus your loan, which is the 9 million Rand. So it grows to a similar value as in scenario 1. But if we had to go look now at what the estate duty would be when you pass, you've got your capital gains tax at death. Sorry, I forgot to mention that we assume that the trust put this money into an investment wrapper, which would pay a lower capital gains tax of 12% instead of 18%. We assume that you have some running costs that go along with the trust, like your administration costs and your different taxes you have to pay on the loan. And your estate duty would only be 2.2 million Rand. If we had to compare the previous scenario of 12 million Rand. And why is that so substantially less? Well, here you're paying estate duty on the full 67 million. Here you're only paying estate duty on the asset in your estate, which is the loan of 9.3 million Rand. The rest of that growth has taken place in the trust and is not attributed to you or your tax returns. So that's the big difference, is you do have more costs within the trust. There is still CGT that the trust would pay on the growth, but the value of the asset in terms of estate duty for yourself at age 80 is meaningfully less, about a sixth of the amount. So it's not to say trust is the be-all and end-all. There are negatives to trust, which we will cover. So just to show you the example here, the difference is around 14 million Rand in this case, that the family got more compared to if he had kept it in his own hands and paid the full estate duty. So this doesn't necessarily have to be an investment. The same logic applies to shares in a private company, to investments locally or offshore, to fixed property. So obviously we advise you accurately on your personal situation, but it's just a good example of how one can plan for estate duty quite meaningfully in the right situations. So just my takeaway before we head into the questions, and I'll bring Nick back. 3 things to take home is I always think you can't plan just for tax efficiency and estate efficiency first. A big thing in the country now is where your beneficiaries live. All the tax planning conferences we go to and all the ongoing learning that we do is generally clients have, a lot of individuals have their children overseas at the moment, and it can get very complicated. Each country has its own tax law. So you need to make sure that everything you do is, I think, accurate to your situation, and not to go and make changes to your estate plan without getting professional advice. Plan for the cash. So I think we've highlighted that quite clearly, is to make sure that that liquidity is planned for. If you look at a lot of individuals at the moment, they've got their pension funds, they're putting a bulk of their wealth into these wrappers, potentially offshore wrappers. They've got their fixed property, they've got trusts. Actually, you can have very wealthy individuals with very little assets in their own name. And how is that estate going to pay for estate duty? Because these offshore wrappers sit offshore, that estate duty needs to be planned for. So either the offshore wrapper needs to pay out to the estate to fund that, or you need to plan for it in other ways. Life cover is one option that can be a good solution there. And to make sure you've named beneficiaries where you need to. There's nothing worse than having a pension or a living annuity or an endowment or a wrapper, which can have a beneficiary on, where you just don't realize you haven't nominated a beneficiary on. That can be quite a costly mistake to do in terms of tax, particularly on pension funds. So you don't want to make that mistake. Okay, good, Nick. I'm going to bring you back, and yeah, please chip in and let's go through some questions.
Cool. Thanks well done, Stuart. A lot going on. Thanks for submitting all your questions. We had a lot. We won't be able to get to all of them. We've selected 8, which we thought are probably the most relevant at this stage. Let me kick off. So, how can I make sure my beneficiaries do not misuse the money I leave behind? That is one that Are you going to be rooting from the grave? Stuart, what do you say?
Yeah, it's a good question, Nick. I mean, I put it first because we see this practically a lot. Often, everyone has their own view about ruling from the grave. I know most accountants or estate planning lecturers will say, it's not the best to rule from the grave, but I understand it's difficult to pass on your wealth and feeling like you don't have any control about what happens to it after you've passed on. I think the different ways to do it is obviously within beneficiary nominations, understanding how each of your investment products work. Living annuities are very different from pension funds and retirement annuities. Endowments act very differently. These days, what we call wrappers, which are sinking fund investments, have their own treatment. I think you really need to understand very clearly how your different investment assets will pass on to your beneficiaries. I think a lot of people just write a number on an application form, they fill in a family member or various family members and some percentages, and don't actually have an understanding of what's going to happen after they pass. If you are really fearful about particular family members that won't be able to handle lump sum cash, then really the only way you can manage that is to use a form of trust. So you can either set up a trust while you're alive, which has particular rules on how that capital will be used and how the beneficiaries can get paid the money, all at the discretion of the trustee, or you can set up a testamentary trust, which means your assets will continue to be held by you, potentially your spouse, and then on the passing of you or your last surviving spouse, then that trust could be set up, which is called a testamentary trust. So that's one of the main ways that you can really be safe about it if you do have a lot of doubt. Otherwise you are leaving it up to chance.
Yeah, well done. Thanks. Yeah, I have investments in South Africa and overseas, with one child in South Africa and two overseas. How does this estate planning work in this case? This is very common. We deal with this a lot.
Yeah, so I must say this is not easy these days. The big thing is which countries the children live in. Um, Myself and my colleagues and Nick, we're doing a lot of learning about the double taxation agreements. So the double taxation agreements is the legislation that South Africa has with most other countries out there, and each country relationship has its own agreements on what happens in terms of taxation as well as what happens in terms of inheritance. So it really, where your children live is important. I think first and foremost is you've got to understand how your assets are going to pass on when you pass away, potentially your spouse passes away, and then to your children, how those assets are going to be seen in that child's country for tax residence, and what is the nature of the investment you're passing on. Is it cash that you're giving to them? Is it ownership of an investment like an offshore wrapper, or is it a pension fund that's going to pay out? All of that will determine the implications for your children overseas. So in terms of how does this affect your estate plan? You have to go through the process of doing a full estate plan to really determine that. And often, if your child is in a country with less favorable tax laws, generally, actually, the UK has become quite a lot stricter these days. I know Netherlands is a strict one, USA is a strict one. Often they may have to consult a tax consultant on their side to get opinions as well. So it can get quite complicated, and you have to go through the full process to really understand the implications of your estate plan.
Cool, thanks, Stuart. Okay, how do I include offshore assets in my local estate plan?
Yeah, this is a really good one. It really depends on the nature of those assets. The rule is, or the rule of thumb is, let's just call it a soft rule, is if you've got assets that would cause you to have an estate in that country, a big one is fixed property. I know quite a lot of people have can have fixed properties in different European countries, as an example. then it really normally makes sense to have a will in that country. The will in that country that would govern that asset alone, and not have an SA executor have to deal with foreign speaking attorneys overseas and have that foreign asset hold up your SA estate. So if you've got assets, it could also be shares that sit in a foreign country that would cause you to have an estate in that country. You generally want to have two wills. You want to have a local will and you want to have an offshore will. You don't want to have what's called this worldwide will. If your investment assets offshore, or if your assets offshore are an investment in nature, then you want to make sure about the jurisdiction. And we've done numerous webinars about US jurisdiction versus UK jurisdiction, how it works. And you would know that we feel very strongly that if you are an SA tax resident, an offshore wrapper is a great investment asset to have, because it allows you to to own and hold offshore assets without it causing you to have a foreign estate, either in the US or UK or wherever your assets may be held. So you need to consider the nature of your assets and what the tax implications and estate implications would be in that country, depending on the jurisdiction.
Yeah. Okay, next one. Thanks, Stuart. Are there similar investments besides endowments that allow for a beneficiary?
Yeah, I mean, there's a few. I can list them off, but yeah, maybe I'll just list them quickly. So normally the different types of policies one would have that allow for beneficiary is first and foremost your life cover policy. Secondly, an endowment, which is an investment that acts similar to a life cover policy. When you pass away, the endowment pays out to your beneficiary. Then you get what we advocate for a lot is what's called a sinking fund wrapper. So instead of paying out the investment and the investment being sold, the sinking fund wrapper would actually allow your beneficiary to take ownership of the investment and carry on with the investment. We feel this is very valuable, particularly for offshore investments where you don't necessarily want the investment to be sold and paid back to South Africa. And then there are other investments. A tax-free investment allows you to have beneficiary nomination. And then you get all your normal retirement funds, like your pension funds, provident funds, preservation funds, your retirement annuities, and your living annuities that all allow beneficiaries. So all of those different types of assets that allow beneficiary nominations would not be handled by your will normally. So as I said, it's really important to see your estate plan as one big thing. Make sure your beneficiaries and your will talk to each other and not do them as separate exercises.
All right, thanks. What are the donations tax and capital gains tax implications when giving money to children or bringing money back from offshore investments?
Yeah, so this is actually two separate questions. I'll answer them separately. So donations tax implications of giving money to children. So I think SARS has just increased the amount that we're allowed to donate per year. I must check. I think it's gone from 100,000 Rand to 150,000 Rand that we're able to donate per year. That you can give to your children as a gift, but you are capped at 150,000 Rand per person, not per person who receives the money, but per you as the donor. So it's not an enormous amount, especially if you're trying to give wealth to your children. The rule is you generally can pay bills for them. So they say rulers don't give them cash, but if you have children that are maybe young adults and you're still trying to help them in life, is you can pay bills for them as a dependent, and that isn't seen as a donation normally. But if you wanted to start giving them money while you're still alive, the most common way to do it is to do a loan agreement. So for SARS not to catch you on donations tax, which is 20% up to 25%, but for you to rather give your child an interest-free loan. So similar in how you would give money to a trust, but you could do it to your child or your children, in that you write up a loan agreement that you're giving them this money as an interest-free loan, and essentially they don't ever pay you back the loan. And then when you pass away, you bequeath that loan to your child as part of your estate. So that loan just pushes back any donations tax implication in that the estate duty would only be payable when you pass away. Capital gains tax from bringing money back from offshore, depending on the nature of the investment. If it's an investment that's been in an asset that's grown, you'd normally have capital gains tax. Capital gains tax, if it's in foreign currency, the way the calculation works is you take the growth in foreign currency and then you multiply it at the rand exchange rate, and then you calculate what your capital gains is in rands, and then you include that in your tax return. And then that capital gains in rands is what you would be taxed on, up to your normal 18% tax rate on capital gains.
Right, next one. I still have an active retirement annuity. What happens to it when I pass away?
Yeah, so we haven't touched on retirement funds much because retirement funds I know can be quite a confusing one for individuals, and that retirement fund sits completely outside of the whole estate planning wind up. They normally would have beneficiary nominations on, but the different investment accounts have their own rules. So how it works for an RA is that you can nominate beneficiaries. Those beneficiaries can then choose if they want to cash in their portion of the fund, or if they want to move their portion of a fund to a fund in their own name, is simply how it is. They can also do a combination. Any cash would be taxed as per the normal retirement tax tables. Those tax tables aren't friendly. They go up to 36% quite quickly. And any fund that they take would basically move to a living annuity that would move to their own names. And they would then continue on with that fund in their own names. The big thing to remember or to be aware of around retirement annuities is that the trustees of the fund have discretion. So if you are a member of a pension fund or an RA and you nominate your friend as the beneficiary, but you have a wife and children, the trustees of the fund are normally going to override you, and they are going to look for who your blood dependents are and factor that in. It's not the same with other investment vehicles where your beneficiary nomination is binding. Retirement funds are governed by their own law, and in South Africa, the trustees have discretion of how they wind up your retirement funds, and that they allow themselves up to 12 months to go and determine who your beneficiaries are and make the determination of who gets your funds.
Right, thanks. Are trusts still a viable option for long-term asset protection, considering the high tax rate applied to trusts?
Yeah, so I mean, trusts can be a webinar topic all in its own. Trusts get more and more complicated every year in South Africa at the moment. I think that trusts at the moment have their pros and cons. The big cons being the ongoing costs of a trust, so the costs around actually having professionals manage the trust. Gone are the days of writing up a trust deed and not filing regular accounts, not doing your tax returns. These days you have to do annual financial statements, you have to file annual tax returns, and you have to have an independent trustee on a trust. So all of that is costly. Also, the high tax rates as mentioned here. How high the tax rates are really depends on who the beneficiaries are of the trust. If you all natural persons and all South African tax persons, you can still have reasonable tax rates within a trust. But these days, if you've got foreign beneficiaries that you want to pass money or distribute money to out of the trust, now they're taxing those distributions at 45%, which is very unfriendly. So definitely, if you've got foreign beneficiaries such as children overseas, trusts are really, really difficult to do with foreign beneficiaries now. But yes, they are still a viable option, and it really will be a pros and cons discussion depending on your personal situation.
All right, thanks, Stuart. Okay, last question. What is the value and cost benefit analysis of a trust versus estate planning in simple terms?
Yeah, good. I know this is similar to the previous question. This is how I think of it. Is really is a trust is an asset, or sorry, not an asset. It's a entity with its own costs, And what is the value you get out of that? Well, the value really depends on your situation. In the example we illustrated earlier in the webinar, that individual got a lot of value because it allowed that asset that he had to grow outside of his personal estate and saved him a lot of capital in estate duty. Simply the estate duty saving itself was around 10 million rand. So in that example, it made sense over and above all the extra costs of running a trust and your complications of a loan account, which is called your deemed donations on the loan account that you would have to pay every year. So when you have a trust, you need to really stomach those upfront costs. And we have some individuals that are fine to stomach those costs. On a 10 million rand asset, it's maybe a few 100,000 rand a year you have to pay in tax and cost to run the trust. But if you see how it can benefit you from an estate perspective, then it makes sense. If you're someone who the asset potentially is going to be used in your lifetime, your beneficiaries are offshore, then a trust would be a lot more unfavorable. So we'd have to look at it on a case-by-case basis. So trusts do have a place still, but they are losing their attractiveness the more that SARS looks at them. And we haven't really even spoken about foreign trusts, but foreign trusts are very expensive offshore. And while foreign trusts can have a place, they're not too popular at the moment because they are very expensive to run. Okay, well, that's all from me. I think we're done with the questions, so I'm going to hand over to Nick for the closing.
Okay, thanks, Stuart. Sure. I know there's a lot going on there. I really would suggest to everybody to get your estate plan reviewed. We have had some unfortunate situations where some clients have just continued to neglect and delayed doing their estate plan and unfortunately left quite a headache to some of their kids. Just a little bit here on Investonline. Remember that we have proven investment experience, a proven track record. Fees are always important, and I mean they're completely transparent. We work as a team. We're a team of 15, so there's always a team effort involved. And the important thing is just a system of ongoing reviews. So we have a very strict system of reviewing our clients on an ongoing basis. And I really would urge you to get in touch with us. Let us have a look at your financial plan. And obviously with that goes into a review of your estate planning as well. Right, so we got our next webinar. It's going to be on the 23rd of July, actually in the afternoon, 3 o'clock. I'm going to be talking with John Bickard. John's in New York, so he'll be in the New York office. I think a lot of people know John. I mean, he's the top fund manager in the country, award-winning, just recently won the top equity fund manager, best performance over 10 years, 5 years, and I think 3 years as well. So this is definitely one not to miss. We will send an invite out. But yeah, looking forward to having a chat with John. He's got some really good thoughts and also can be entertaining as well. Right, thank you everybody for joining us. And yeah, get in touch. There our details are, and we'll see you soon. Cheers.